Well, hey everybody, Rob Satcham from FeedbackWrench.com. We're going to talk about what is the best small business retirement plans. There's going to be two parts to this video. Here we go. So what are the best small business retirement plans, and how can you best utilize retirement plans and the stock market to destroy your taxes as an entrepreneur while building up your wealth like crazy? My name is Rob Satcham with FeedbackWrench.com, and we do web design, SEO, marketing, consulting for small businesses. Our mission is to help small businesses go from good to great. And the reason why is because we want to help maximize the efforts they put into their business while building something that could last for generations. The three major ways to reduce your taxes in your small business is: first, become an S Corp to reduce self-employment taxes. Second, use benefits and retirement plans. And third, use real estate investments. In this video, I'm going to be talking about the best retirement plans to reduce your taxes, but check out our channel to learn more ways to reduce taxes and grow your business, especially our coming content about reducing your taxes with real estate. This is like the secret of the rich, folks. All people should be invested into the markets, their small business, and real estate eventually. When you invest in those three areas, you'll get the advantages of all sorts of economic and tax benefits. When it comes to the markets, there is a huge difference between people that make great returns and people that make measly returns. So I broke this video into two parts. The first part will remind you how to avoid stupid mistakes when investing that cause people to have really low returns. And I'll end this section by talking about what could be the most important investing concept you ever learn. This concept legitimately will probably save you hundreds of thousands of dollars, and you will have a much larger retirement account. I'm serious. I'm going to share with you the dirty little secret that Wall Street doesn't want you to know. And then I'm going to show you how to invest yourself in a third video. For the second video here, I'll dive into exactly which retirement plans are best for small business owners, particularly for single owner S Corps and those with smaller teams. I'll illustrate what kind of taxes could be saved, some of the basic rules, and I'll explain precisely what I've found is the easiest way to implement those plans. Hopefully it'll be helpful. So there'll be three videos here. This video is for example only and shouldn't replace any legal or tax advice or professional services. All right. So here are the basics that could be the difference in hundreds of thousands in returns. So first off, just bear with me here. Let's talk about some general investment advice real quick. I recommend using easy to use mutual funds and exchange traded funds called ETFs from Vanguard. Basically, these make buying a diversified portfolio really easy. One mutual fund share is like a combination of dozens or hundreds of various stocks, bonds, and cash. ETFs and mutual funds make diversifying easy, but in exchange for the convenience, there are costs and fees inside of those funds. I know most entrepreneurs shrug off some of these details, but I really want to help you pay only your fair share in taxes, and I want to maximize your every investment that you make. And this is serious stuff, and I want to make sure you pay only your fair share in fees as well. If you pay attention here, this information could legitimately increase your returns by hundreds of thousands, so stay with me here. Another thing, I meet entrepreneurs all the time that claim that they hate the stock market and they'd much rather invest in their business or real estate. To those people, I get it. You look at your business and see massive return, but there's a catch. Only investing in the stock markets lets you leverage what Albert Einstein called a wonder of the natural world, and that's compound interest. Time plus compounding interest can do amazing things. Don't miss out on its real power. My argument is that everyone should be invested in all three areas: their small business or their business, the markets, and real estate, because they provide diversified benefits, returns, and tax treatments, and that's a key there. So yeah, you should be socking away 5 to 20% of your income into the stock market just so you can take advantage of time and compounding interest. All right, moving on. Mutual funds and ETFs have different combinations of stocks and bonds meant to accomplish various levels of risk and objectives. Some are meant to grow your money with extra risk, and some are meant to be a lower risk thing, and then some provide income. Stocks are riskier because they're companies pursuing growth, while bonds are just they're debt instruments that you buy and typically provide less risk for less reward, and they generally speaking provide stability. Bonds are sold by governments and corporations as debt, and then they pay an interest rate to the owner of the bond. the higher quality the company is, or the more trustworthy that company is, the more likely they are to pay that money back. So the quality of the bond goes up. You have A, AA, AAA, which means they are less risky. Riskier bonds, they need to attract people's investment dollars because they might default. So they do that by increasing the interest rate that they promise to pay the investor. Catch is that only happens as long as they keep their promises and they stay. Ultra safe bonds, they don't need to attract dollars their way so that their interest rates are much lower. Those are like T-bills or government bonds. Safe equals lower interest. Risky equals higher interest. So that's bonds. So here's the most basic. Stocks are generally for growth and they pay dividends, while bonds, generally speaking, are for stability and predictable income and they pay interest. That's higher quality bonds. So mutual funds and ETFs have different makeups. Some are like 100% stocks, some have different percentages of bonds. And the idea is you have various risks. Higher risk equals higher rewards. Lower risk generally has lower rewards. So here's what I want you to know. This is huge. You need to take on the right amount of risk according to what's called your investment time horizon, or how long it'll be till you cash out your investments. Stocks and certain bonds, they fluctuate all over the place. They can go way up, but they can also crash and lose a ton of value. You don't want to have a freak crash right before you're about to withdraw your money for like college or for retirement. That would be horrible. This concept of appropriate risk is the first most critical piece of information for investment returns for both young and old. When you're young, you have a long investment horizon, meaning that you're not going to be taking out your money for a long time. This means that you should probably take on more risk, being more invested in stocks rather than bonds and cash, because it doesn't really matter how the values of those mutual funds will fluctuate while you're in this season of your life acquiring shares, which is really what this is about while you're young. It's about you buying shares, not necessarily the dollar amount of your account. So here's a quick example to illustrate how important proper risk is. Let's imagine you're 25 years old and that you want to start investing $500 a month for retirement. Subject A takes on too little risk. Subject B takes on appropriate risk in a diversified stock portfolio. Subject A is going to average 5%, while subject B is going to be in like an S&P 500, gets an average of 8%. Now let's imagine both of these investors are 25 years old when they start and they invest $500 a month. That means that they will have invested over those 40 years $240,000 of their own money. Investor A, taking on too little risk, earning 5%, would have a retirement account after 40 years totaling $763,000 in retirement. But investor B, who took more risk and earned 8%, that $240,000 over 40 years would have transformed into $1.74 million. Taking the right risk can really pay off. So make sure that you don't take on too little risk when you're young. On the other side, if you're about to retire, if you don't settle your accounts down so they don't fluctuate as much and you get your cash ready to take, if you have a large decline in the markets right before you retire, things can be devastating for you. And I'm not just pumping smoke here. I've legitimately seen people that have made these mistakes and those who have done the right thing, and they end up having very different situations. All right, I get it. This is boring, but trust me, stay with me here. Here's what we've covered so far. So number one, mutual funds and ETFs that you can buy are baskets of stocks and bonds, and they make diversifying easy. Number two is you want to balance the right amount of stocks and bonds according to your risk tolerance and investment horizon. You need to take on the appropriate amount of risk. Number three, here's a big tip. Use what's called dollar cost averaging. So this is important. When you're looking in your 401k or investment account, you need to realize that the dollar value that you're seeing represents the number of shares you own multiplied by their current value. It's not necessarily that your account has $20,000 in it. It's that you have 1,000 shares of a mutual fund that's currently $20 per share. When markets are high, your dollars don't buy as many shares. When markets are low, your dollars can buy more shares, but they're less valuable. Young people freak out when the market goes down, but that just means that you should buy these shares at a discount because your dollar can buy more. The principle is to just consistently invest. Never shy away from investing when the markets are low, and don't jump into investing because the markets are good. You should just pick an amount to save into a certain fund and then plug away at it no matter what happens. What happens is that your investments average out as you buy when it's low and buy when it's high, which is called dollar cost averaging. Just pick an amount and a frequency and stick to it. The idea is to buy low and sell high, but that brings us to our fourth quick principle you need to understand, and that's that nobody can time the market, not anyone. Nobody has a clue what's going to happen. We can't predict crashes, we can't predict upswings, we can't predict anything because the markets are efficient for the most part. So when you hear someone predicting, they're just speculating no matter what. Otherwise, they'd be trillionaires. This is called the efficient market theory, and it really applies to investment firms. The idea is that no investment firm has any better knowledge than anybody else, and priced into the price of a share is all of that information. So now listen carefully. This part could potentially save you hundreds of thousands. This is my big piece of advice. Number 5, choose low fee mutual funds. There are 2 types of management of these mutual funds and ETFs. You've got active management and passive indexes. Each of these mutual funds have hundreds of millions and billions of dollars all acting in unison, and they're buying. And when you're buying one share of that mutual fund account. There are teams of people that make decisions according to the prospectus and the plan of the fund. Actively managed funds have teams of people doing massive research to try and make money in the market. They're constantly buying and selling stocks, making bets, capturing gains, cutting losses, taking stands, long or short, in different sectors. Active managers are sometimes right and sometimes wrong. But research is starting to imply that active managers get it wrong far more often than they get it right. So active funds have lots of betting going on. They're capturing gains, releasing losses. They're making opinions about sector growth. These funds are simply managing to their predetermined. And then besides those, you have what's called passive index funds. Instead of active management, you have passive index fund. These funds are simply managed to their fund prospectus, or what's called a predetermined index. They don't make bets and they don't mess around at all. They buy what's on the index list and that's it. They are passive. So here's the deal on active versus passive funds. This is a hot debate. Wall Street and mutual fund managers, they make way more money when they are making bets and doing active trading, like way more. Wall Street makes more money on actively traded funds because they're making bets, but research is implying that the overall returns in these actively traded funds are lower than those in the passive indexes because there's an opportunity cost. They get it wrong. So if Wall Street wants to attract people's investment to their best paying products, what do you think they do? They pay their salespeople large commissions on the more profitable actively traded funds. So Wall Street jacks up the internal fees of the funds, and those fees go to pay everyone from the investment advisor down the street to the actual team managing the fund. So actively traded funds are way more expensive for customers. And research is showing that in spite of what the salespeople claim, they actually get returns on average that are lower than these passive index funds. Since index funds don't have that much going on inside of them, and they're not paying big old commissions or salespeople to help them sell, they have far lower internal fees and upfront fees. And these little differences in fees can drastically change your retirement picture. I'm talking big time here. So here's a quick example. Let's say you buy a mutual fund from a good company, but it's actively traded. And maybe it's in an account, maybe with an additional fee or something. And it costs you 1.3% every year versus a 0.3% Vanguard S&P 500 index fund. That's 1.3% versus 0.3%. That means you lose 1% in earnings. So let's look at our previous example. You're 25 years old. You're investing $500 a month till you're 65. Investor A is going to get 7%. Investor B is going to get 8%. Investor A would have a portfolio of 1.3 million. Investor B would have 1.7 million. That's a $430,000 difference. That 1% is a very big deal. Part of why that's so exaggerated is because we're starting at 25 going to 65, but it applies at any length. But that's just a generous example, folks. Here's the dirty truth. When I was in the industry, investment advisors were pointing people towards products that would have much higher internal fees and had actually lower returns than what I'm showing here, because the actively traded funds, they just get it wrong. Trust me, ask a financial advisor and press them on it, and they'll end up showing you historical results of their managed portfolios that are way lower than the indexes almost always, particularly when you consider the net after all the fees. Most of the time, if you were seeing a potential return of 8% in the portfolio, when you did all the math, you'd probably be earning 5.5%. I'm not exaggerating here. Your wrap accounts and low quality mutual funds have this all the time. So 5.5% versus 8% at $500 a month from age 25 to 65, this is amazing. That 8% would be a $1.7 million portfolio, where at 5.5%, you'd be earning $870,000. That's an $874,000 difference. And I'm not exaggerating here. This dirty little secret is something that the industry does not want you to know. I see regular old people rolling over their accounts into these wrap accounts or just lower caliber mutual funds where the fees are way higher, and then they get convinced to save even more money. The only advice that was actually really given was that they should go into an asset allocation fund. When you start doing the math, these funds have horrible returns compared to the S&P 500 indexes and then low fee funds from Vanguard. So then there's this extra dirty little secret. So since this new fiduciary law that the Department of Labor has been trying to push through came along, the industry has been doing some really stinky stuff. Regulators never understand this. Knowledge, not regulation, is usually a better answer. So this regulation is potentially going to be coming out. And what the industry has been doing is telling people that they need a fiduciary and that the only way to get that is to invest their money into this wrap account or this managed account. The advisor ends up going from much lower fees to an actual higher fee. They'll earn like a 1% fee every year for your account, and the company takes a cut on top of that. And then the underlying fee has funds. There's 3 layers of fees. So you have the advisor taking a fee, the company or the manager taking a fee, and then the underlying fund company is usually taking a fee. You look at the fee structures, a lot of times you'll see that an 8% general return is getting notched way down to 5.5%. That's very common. I'm telling you folks, 90% of the advisors out there are trying to act like choosing investments is so hard and that you need to pay a fee, which might be true, but they never tell you that over 40 years, those fees are going to cost you $875,000 in this example. Or just go over your fee structure compared to a passive index fund at Vanguard. Now, I can just hear advisors yelling and rolling their eyes while they're watching this video and saying I'm exaggerating, I've cherry-picked my data, but the problem is that I've seen this in real life. And the Morningstar reports can show you too. And I haven't even started talking about variable annuities yet. The main problem is that people rarely see the fees getting taken out. They might see on a wrap account that they have a quarterly fee coming out, but really what they see is that their portfolio kind of acts in the general way that the market fluctuates, just kind of like the index. So their account goes down 10% in one quarter, which might have been just a shade worse than the index. But then the next quarter it rebounds, it goes up 13%, and it might have been the same as the index. They never understand the opportunity costs and the total fees. It's very hard to see. It's very opaque. So all that to say, I highly recommend that all investors call Vanguard. Schwab does a good job, and ask for passive index funds. You still need to stick to all the principles. So here they are. Number 1, mutual funds and ETFs help you have a diversified portfolio. Number 2, you want to balance your risk with stocks and bonds. Make sure you take on the appropriate amount of risk. Number 3, use dollar cost averaging, sticking to a certain frequency and not jumping in and out of the markets. Just invest consistently and it'll average out. Number 4, nobody can time the market. Number 5, choose low fee index funds. So stay tuned for the second part of this video where we'll teach you about the tax efficiencies behind specific small business retirement plans and also walk you through the SEP IRA, simple IRA, 401ks, individual Ks, and even some other very interesting retirement plans that you can do. And you will save tons in taxes. So stay tuned and appreciate your time.